Now let's talk to Dimeji Obasa, fixed income dealer at Access Bank. Hi, Dimeji, good afternoon and welcome to the program.
Good afternoon. Thank you for having me.
Great. I don't know, were you expecting that change to be that much or to be in the direction we saw it, talking about the CPI that was released yesterday?
Oh, yes, we expected the change, and this is because of we had heard the news that there was going to be a rebasing, but that was not necessarily what we can attribute the bulk of the change to. The bulk of the change can be attributed to the change in weighting. The weighting is essentially the components that make up the CPI figures and the weight that they carry in the computation. So that's like where we saw the bulk of the impact from, and that caused the reduction that we saw.
So, I mean, bottom line is that now we have a positive interest rate. So, of course, what that means is that inflation is now lower than our interest rate. That should be positive for investment. Do you see that? I know perhaps it's too early. There's an auction today, I believe. It's too early to expect that to seep into investors' action for today's auction. But can we expect that to make a difference in the fixed income space?
Oh, yes, we've seen that cause a significant rally in the markets and the fixed income space. It's not clear whether or not we will maintain that real positive interest rate for long. As you noted, there's an auction today. The general expectation for that auction is to close at a discount rate of 18.5%. So the yield on that should be somewhere around around 20%, or maybe between 20 and 21%. So that would take us back to having negative real interest rates again. However, if you go further down the curve on the bond side, we might start to see markets react to that and maybe move prices up if the real interest rate is something that is of serious concern to investors. But that doesn't seem to be the case at the moment. Right now, we just have a rally in the market. There's a lot of cash chasing the securities, and we expect that it to be bid a lot lower this time compared to the last auction.
But how do we expect this to change or affect the decision of the MPC? Their meeting starts today. We're expecting the decision announcement tomorrow.
Well, it's very clear that at the very least, they are going to keep the rate steady. That's like the worst case scenario that we see. For sure, what the most likely to be the case is that we would have a reduction in the policy rate. They might, however, want to just keep it steady just to not be too reactionary, and then see what the next print of the CPI would be next month or the coming months. But we do not foresee that they would be looking to hike rates any further. The most likely scenario today, or rather tomorrow when they announce their decision, would be a reduction in rates, with, for our side, base case being that they would just leave the rates at where they are.
Do you think there's the possibility of a reduction in rates at this time? We're still heading to our target of 15% when it comes to inflation.
Yeah, we are far from that, but we still have, we've had like a significant reduction in inflation, albeit as a result of a change in the way inflation is calculated. But at the end of the day, if they simply go by the data, the most likely case is that they would cut rates, even if it's just to show the markets the direction that they see rates going, and by extension inflation. For us, the most likely situation, or most likely scenario, is that they will cut rates.
Yeah, so you've noted that perhaps that positive interest rate may not last for long, but how do you expect all of this to affect domestic borrowing of the federal government especially?
So what we have in the market currently is we currently have a bullish run where rates are coming down very fast. That might be short-lived. Today, we would see the outcome of the NTB auction. As I said, like the general consensus is around 18.5% handle. On the bond side, which is where we have a really high rate, particularly from the last auction where the 2035 closed at 22.6%. We've seen that particular bond trade to as low as 20.6%. So it's very likely that at the next bond auction, we would have a reduction in rates. Now, what that means is that the cost of borrowing from the federal government, as far as borrowing from the capital markets through fixed income securities, is expected to reduce. So we should see a reduction in the federal government's cost of borrowing from the capital market through these fixed income securities, in line with the general market sentiment for lower rates at this time.
All right, Dimeji, thank you so much. Well, we do hope it will reduce our debt servicing, but we'll see how that goes, because the budget still has to be funded one way or the other. But thank you so much, Dimeji Obasa, a trader at fixed income trader at Access Bank.
Thank you.